One of the oldest tricks in marketing to make something sound advanced and intelligent is to prefix it with the word smart. Smartphone, smart TV, smart watch, smart city, and of course, smart beta mutual funds. So how smart are smart beta funds? It's a question our team has been grappling for some time now, and in this video, we shall get a detailed look into this growing category of funds with a lot of data and studies that can help us understand all sides of the argument. But to keep it simple, smart beta funds are nothing but funds that have a weighting methodology that is different from, say, the Nifty 50 or the Sensex, which are weighted on a market capitalization basis. These funds come under the universe of factor investing, and that being said, let's start with an understanding of what a factor is. A factor is a broad characteristic that often explains a stock's return or its inclusion in a particular basket. For example, market capitalization or size of the company is a popular factor and forms the basis for the creation of the Nifty 50, the Sensex, the Midcap 150, Smallcap 250 and other indices. Similarly, there are many other factors like value, momentum, quality, low risk, etc. that can be used in isolation or as a combination to create some really unique basket of stocks, an approach that is also known as factor investing. For instance, a value-based factor investing process focuses on identifying companies whose share price is lower than their intrinsic value per share. This is done using multiple metrics like the PE ratio, the PB ratio, price to sales, dividend yield, enterprise value by EBITDA, buyback history, etc. Similarly, other factors are derived using different metrics and quantitative methods. Now, of course, none of this is standardized. Every analyst, every fund house would have a different model to define what is momentum, what is quality, and what is value. In quite the same way, a particular company need not be labeled under just one factor, which means an HDFC bank can be a value stock at one point of time, it can be quality in another time, and as the case with most of the popular and well-run companies, they can be tagged under two or more factors at the same point of time. In fact, a lot like how a company can fit within two or more factors, many of these smart beta investing models use a combination of factors. Sometimes they use two factors, sometimes three, and there are even some indices that can go up to 4 factors, as one can see in the table here. Now, one perception that investors might have is that a multi-factor smart beta fund performs better than a single factor one. It's a valid hypothesis and something that we'll soon address in this video. But having said this, I'm sure we can all agree that multi-factor strategies are certainly more marketable. I mean, instead of saying we invest your money in quality companies, it does sound a lot more convincing when someone says we invest your money in quality companies which have low volatility and have an upward price momentum. So there's a bit of showmanship here, and investors have to get smarter and ensure that they invest after evaluating the data rather than looking at the marketing materials. Smart beta funds are gaining in popularity all around the world. In numbers, the strategy has garnered over $1 million worth of investments and is showing no signs of slowing down. Specific to India, we presently have a few mutual funds and exchange traded funds that are based on smart beta strategies, and it's a number that we think is likely to grow rapidly as people get more aware about these funds. In fact, in a promising sign, HDFC mutual funds just last month applied for 9 new ETFs, of which 4 of those followed a smart beta strategy. The Nifty 100 Low Volatility 30, the Nifty 100 Quality 30, Nifty 200 Momentum 30, and the Nifty 50 Value 20 strategy. So smart beta funds are definitely a space that one needs to watch out for, and we expect a lot more innovation and research to pour into this growing category of funds. And speaking of growth, you'll be happy to know that the ETMONEY YouTube channel has now over 200 well-researched and actionable videos on personal finance and investing. We sincerely hope you have subscribed and have joined our growing community, and would really appreciate if you can also tell your friends about it. Let's start with an examination of how the Nifty Smart Beta indices have performed over the last 5 years. From a return perspective, most of these indices have done far better than the popular Nifty 50 index, which has delivered an annualized return of 16.8% during the same 5-year period. Also notice that the top 3 indices in this list represent 3 different factors, that is alpha, momentum and value, which is interesting, and we'll share a little more information on that in just a moment. What also comes as a surprise here is that the multi-factor indices have not performed as well as the single factor one. A plausible reason for this might be the fact that these multi-factor indices are not always looking to maximize performance. They also aim to reduce volatility, which is what they have done here when we look at their standard deviation and beta scores, which are on the lower side. Now let's stay on the returns part and examine the top 3 smart beta indices in greater details. These are the Nifty Alpha 50, the Nifty 200 Momentum 30, and the Nifty 50 Value 20. A quick comparison shows that these 3 indices have visibly outperformed the Nifty 50 and the Nifty 100. And although the excess returns have come at a higher level of volatility, our smart beta indices do seem to offer a better risk-return equation to its investors. However, this performance is not a straight arrow, and like any journey, our smart betas have also gone through many peaks and troughs. Take for instance the Nifty Alpha 50 index, which has been the best performing smart beta strategy over the last 5 years. Now notice how distinct the performance of the Alpha 50 index has been in some of the years. I mean, look at 2013 when it underperformed the broader indices by almost 10%. Then the next year in 2014, it overperformed by at least 20%. And then look at 2016, 2018, and again in 2020. The ups and downs for the Alpha 50 index have been a lot more sharper than the Momentum 30 or the Value 20 index. In fact, let's extend this comparison further and examine how better or how worse all these 3 indices have performed relative to the Nifty 200. Okay, so the erratic performance of the Alpha 50 index is visible when compared to the Nifty 200 index as well. And this variation in performance is something an investor needs to be wary of if you're considering investing in the Alpha 50 index. In that regard, the Momentum 30 index seems to have a more consistent outperformance over the Nifty 200 and has given excess returns in 9 of the last 10 years. And finally, we have the Nifty 50 Value 20 index, which seems like a case of closet indexing, with its performance being tightly correlated with the Nifty 200 index. But what's interesting here in this table is how the momentum and the value factor always seem to be at a distance to each other. I mean, look at 2012, 2014, 2015, 2017, 2019, and again in 2020. In all these years, when value did well, momentum did not do well. And when the sun was shining on momentum, it was the value index which was on a wet patch. So there is some seesaw balancing that's going on between momentum and value. And as investors, this can be a good opportunity to build some diversification and risk management layers in one's portfolio. In fact, if you want more details on momentum investing and more specifically the Nifty 200 Momentum 30 fund, then please be sure to watch the related video, the link of which is available in the description. Now, with all 3 indices going up and down, the question troubling us was, is there one factor which is a cut above the others? To understand this, our researchers looked at 4 different indices: a momentum index, a value index, a low volatility index, and a quality index. The idea here was to understand performance purely from a returns perspective and how each index was performing over the last decade. The mapping exercise revealed that every factor, that is each of these 4 factors, had been a first ranker and had also been a last ranker at different points of time over the last 10 years. Of course, when we see the patterns more intently, we notice that the quality factor has had more disappointing years than the others, and that the Momentum 30 index had had a tremendous run, especially from 2014 to 2017. But having said this, it's still important to know that these up-down cycles can be pretty long. So where momentum had those superb 4 years, it can also go through 4 years of underperformance in the near future. The point is, factor rotation happens from time to time, and no single factor should be seen as a sure shot way to create wealth. And in that regard, we think an investor is probably better off targeting the right risk return profile rather than targeting the highest performing factor. So say for instance, if your existing mutual fund portfolio is tilted towards actively managed funds, then it is very likely that a majority of your funds are going into growth funds. In such a scenario, you should look to introduce more style diversification by investing in a value-based smart beta fund or a low volatility fund. In fact, another way of looking at diversification is by investing in factors which have little overlaps in terms of their holdings. A good way to understand this is by examining the top holdings of the Nifty 100 Quality 30 Index and the Nifty 500 Value 50 Index. Now notice here that none of the top 10 holdings in the Quality Index matches up with the top 10 holdings in the Value Index. And while more needs to be detailed out here, having some allocation to different factors can bring down and smoothen out the volatility in one's portfolio, and in some cases even improve the risk-adjusted return over time. Like everything else, factor investing too has some pros and cons. On the positive side, it is a relatively transparent approach to investing and a lot easier to understand when compared to the active style of investing. Secondly, it is a rules-based methodology which significantly reduces emotions and subjectivity, which would otherwise have eaten into an investor's returns. A third advantage is clearly on the risk management side, where a combination of the right factors can help with diversification and in reducing portfolio volatility. And finally, smart beta funds tend to have an expense ratio that is a lot lower as compared to an actively managed funds. But having said this, factor investing also carries some niggling concerns. The first major concern, and this is something specific to India, is that a lot of these strategies have not been properly tested through a persistent bear market. You see, the data we have on factor indices goes back to 2005, which means all backtesting that has been done is on one bull market between 2005 and 2007, one smallish bear market from 2008 to 2011, and one super bull cycle that started in 2014 and is still on. So that's something that one needs to be cognizant of. A second concern with factor investing is that while back testing often shows impressive results, the actual results may not always follow the same pattern. See, what happens with back testing is that the model creator is working on data that he or she already has access to and is sort of torturing the data to achieve a predefined goal. But when it comes to its implementation in the real world, there are a few more factors at play that these models often fail to recognize. Things like size of the operations, the incidental costs of maintaining the model, events which were never factored like what we saw with demonetization and the pandemic, and many such different variables. Okay, so there are good things to say and there are issues to deal with. But the question is, should one invest in smart beta funds? In our opinion, factor strategies can play a progressive role in an investor's portfolio, and why not? After all, smart beta funds are a smarter alternative to market capped index funds. They are cheaper than actively managed funds. They promise returns in excess of the benchmark. They have diversification benefits which can temper down a portfolio's risk. And finally, these quant models are evolving and will continue to get better over time. Actually, this last point is the key, and if done well, we think smart beta funds will get a lot more attention and investments. In fact, we really won't be surprised if smart beta funds or these strategies take up anywhere from 15 to 25% of an investor's portfolio in a few years from now. But having said this, it will still be important to keep track of these funds, and that's because the markets, the sectors, and the companies within these sectors are constantly changing. There is higher industry participation in this area with mutual funds, PMS, high frequency traders, fintechs, all lining up with new offerings. And of course, with more computing power, we can and we should expect hundreds of new factors to be emerging in the future. It's a growing field, and if you come across any interesting article or content that's worth sharing, then feel free to post it in the comments box below. And with this, we come to the end of this video. I certainly hope this content we have put forward will act as your gateway to factor investing and smart beta funds. If you enjoyed it, then do tap that like button, do subscribe to our channel, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.